Imagine turning your trading losses into wins by learning to lose smartly. In Best Loser Wins, expert trader Tom Hougaard explains why normal fears hold you back and shares easy ways to stay calm during bad times. Discover how to handle market drops without stress, build a strong mind, and turn failures into success. This book gives real tips to understand yourself better and make more money in trading. Let's find out more.
It really is a provocative title, isn't it? Best Loser Wins.
It completely messes with your head.
It does. It feels like a contradiction in terms. I mean, everything we're taught, right, from when we're kids.
Win. You have to win.
Exactly. Winning is everything. In sports, the best loser is just the runner-up. They don't get the trophy. In, the natural world, the loser gets eaten.
Right. And in business, the loser files for bankruptcy. So how can a loser possibly be a winner? Sounds like a trick.
It does, and that's the whole premise of the book. Tom Hougaard is basically telling us that the financial markets are this bizarre alternate universe where all the normal rules of survival and success are flipped completely upside down.
So all our instincts, everything that helps us navigate daily life,
they become your biggest liabilities. The very things that keep you safe crossing the strait are the things that will bankrupt you in trading.
Okay, so before we dive into that psychology, which is fascinating, let's establish why we should even be listening to this guy, Tom Hougaard. The world is, it's full of trading gurus selling courses from a rented Lamborghini.
Right. The get-rich-quick crowd. But Hougaard is, he's the real deal. He's not a theorist. He has what they call skin in the game. A terrifying amount of it, actually.
I was looking at the numbers he talks about, and they're hard to comprehend. He's a high-stakes day trader. And when he says high stakes, he's talking about risking up to 3,500 pounds per point.
Let's just pause on that for a second so you, the listener, can really grasp that. A market like the DAX or the Dow can move 10 points in, a few seconds on a volatile day?
Easily. A blink of an eye.
So that's 35,000 pounds gone in less time than it takes to tie your shoes.
It's evaporated. He says he's traded over 250 million pounds in notional value in a single day. The scale is just immense.
And he shares these really visceral snapshots of his profit and loss. He mentions making 17,000 pounds in under 7 seconds.
Which sounds incredible.
It does. But then on the flip side, he talks about losing 29,000 pounds in 8 seconds.
And that's the one that gets me. Losing the price of a nice car in the time it takes to, take a sip of coffee.
Right.
That requires a kind of nervous system that I just don't think most humans are born with.
I think you're right, and that's why he's the perfect person to write this book. He's not just talking theory. He's lived in that fire. He's been forged by that extreme pressure that just burns most people out.
Which brings us to the central problem he's trying to solve. This one statistic that just hangs over the entire retail trading industry.
The failure rate?
Yeah, the failure rate. It's brutal.
It is. Depending on the study you look at, it's somewhere between 80 and 90%. 80 to 90% of people who try this end up losing money.
I was thinking about that earlier. Wow. If 90% of new restaurants failed in the first week, people would stop opening restaurants.
Or if 90% of surgeons.
Oh, don't even go there.
Right. The whole profession would be outlawed. But in trading, this catastrophic failure rate is it's accepted as the cost of doing business. And people just keep coming.
So the mission for this deep dive is to really unpack why. Why is that number so astronomically high? And Hougaard's argument is that it's not because people are dumb.
No, not at all. It's not because they don't understand economics or they can't read a chart or they didn't get a good enough degree. They fail because they are psychologically normal.
So being a sane, well-adjusted human being is actually a massive disadvantage in the markets?
It's a fatal flaw. Normal human psychology will kill you in this game. So the journey is about learning how to flip the switch and for a few hours a day become someone else entirely.
Okay, so let's go back to the beginning. How does someone even get onto this path? For Hougaard, it started with a pretty common experience. He was homesick with the flu.
And a book, which is so often the case. The book was Michael Lewis's Liar's Poker.
A true classic. If you haven't read it, you absolutely should. It's this insane story about the bond trading floor at Salomon Brothers in the 1980s.
Total chaos. It's all about greed, excess, screaming matches, practical jokes involving thousands of dollars, the whole big swingin' dicks culture.
But the irony, the deep irony of that book is that Michael Lewis wrote it as a warning.
He did. He thought he was writing an expose. He wanted to show the world how toxic and, frankly, how morally bankrupt Wall Street had become. He genuinely thought that after his book came out, Parents would read it and tell their kids, you can be anything you want, just not that.
And it had the exact opposite effect.
A complete backfire. A whole generation of ambitious young people, Hougaard included, read this description of chaos and gluttony and thought.
That looks amazing. Where do I sign up?
Precisely. It became the most effective recruitment brochure Wall Street ever had. So, Hougaard is lying in bed, feeling miserable, reads this book, and has his epiphany. This is what he wants to do.
So he follows the path you'd expect, the sensible path. He goes to university, he gets a BSc in economics, then he gets a master's in money, banking, and finance. He's arming himself with academic knowledge.
Right. He's doing what we're all taught to do. If you want to succeed in a field, you study it. You master the theory. You get the qualifications. He assumed, quite reasonably, that this would make him a great trader.
And this leads him straight into what he calls the academic trap.
This is his first major disillusionment with the whole industry. We have this idea that the market is a rational machine, that it follows logical rules.
Like a physics problem. If you just know the right formula,
you can solve it. You think if you understand GDP figures and inflation reports and supply and demand curves, you can predict where the price of oil is going to go.
But you can't.
You can't. Because, as Hougaard realized, the market doesn't give a damn about your degree or your elegant equations. It's not a rational machine. It's a voting machine driven by raw, primal human emotion.
Fear and greed.
Fear, greed, panic, euphoria, desperation, all the messy stuff. He says academic theories are built on the idea of rational actors, but people aren't rational when their life savings are on the line. You can't put a panic attack into a spreadsheet.
And nothing shows this disconnect better than his first big win. It's a fantastic story about how luck can so easily be mistaken for skill.
This takes us to September 1992, a day that's infamous in British financial history, Black Wednesday.
Right, the day the UK crashed out of the exchange rate mechanism, the ERM.
For anyone who doesn't know the backstory, the UK government had basically promised the world that they would keep the British pound pegged to the German Deutschmark at a certain level.
The problem was the British economy was struggling, and the German economy was booming after reunification. The fundamentals were completely out of whack.
Totally. The pound was fundamentally overvalued, and a lot of very big, very smart hedge fund managers, most famously George Soros, they saw this. They smelled blood in the water.
So they started a speculative attack. They were borrowing billions of pounds and selling them, betting that the government wouldn't be able to hold the peg.
So that's the macro picture. Total chaos in the global currency markets. Now, zoom in on young Tom Hougaard. He's not a speculator. He's just a student in Denmark.
And he's about to move to the UK for university. He's got all his money saved up in Danish kroner, and he needs to exchange it for British pounds to pay his tuition and his first few months of rent.
So he literally has his education money in his pocket, and he's walking to the bank. Unbeknownst to him, he happens to choose to do this on the very day the crisis is reaching its peak.
The Bank of England is in full panic mode. They're jacking up interest rates to 10%, then 12%. They even promised 15% at one point. They were doing anything they could to stop people from selling the pound.
But the wave of selling was just too big. Soros and the others broke the bank, the peg shattered, and the pound absolutely collapsed against other currencies, including the Danish kroner.
So for Hougaard, walking into the bank with his kroner,
it was like hitting the lottery. Because the pound had crashed, his Danish money was suddenly worth a whole lot more in sterling terms.
How much more?
Well, he says that if he'd gone to the bank a few days earlier, he would have gotten about 12 kroner to the pound, because he waited, purely by chance.
He had no idea this was happening.
None whatsoever. He got about 9 kroner to the pound. That difference on the amount he was changing netted him an extra 4,000 pounds.
Which, for a student in 1992, is an astronomical sum of money.
It was basically his entire living expenses for the year. He jokes in the book that Uncle George Soros paid for his university education.
Yet here's the dangerous lesson from that.
This is the crucial point. He says, don't confuse talent with luck. He didn't analyze the macroeconomic situation. He hadn't read a single research report on the ERM. He just got incredibly randomly lucky.
But the brain doesn't see it that way. When you get a big win like that right at the start,
you think you're a genius. You think, wow, I have a real knack for this. I have a gut feeling for the markets. He admits that early luck is often far more dangerous than early failure.
Because it teaches you all the wrong lessons. It reinforces bad habits.
Precisely. If your first trip to the casino, you lose 100 quid, you learn it's gambling. If you win 10,000, you think you've got a system, and you're hooked.
So let's fast forward. He finishes his education, he moves to London, and he finally gets onto the trading floors. Not at a big investment bank at first, but at these spread betting firms like Financial Spreads and City Index. Now, my mental image, thanks to Liar's Poker, is just constant noise and adrenaline.
And that's part of it. But he paints a much more realistic picture. He says it's a world of extremes. There are long, long periods of absolute mind-numbing boredom.
What do they do?
He says when the markets are quiet, you'd see brokers just sitting there reading comic books or surfing the web, just waiting for something to happen.
But when it kicks off,
When a big number hits or some unexpected news breaks, he says it becomes a melting pot of human emotions. Pure chaos. He tells one story about a colleague who got so angry at a trade.
the PC story, yeah.
He just started kicking his computer tower,
All right.
kicking it over and over again, screaming at it until it was completely smashed to pieces. The IT department had to come and replace the whole thing.
That's a level of stress that is just...
Yeah.
It's hard to imagine that being your daily work environment.
And the money. The sheer scale of the money flying around completely warps your perception of reality. That story about the Russian client with the margin call.
Right. So a margin call, for the listener, is basically the broker calling you up and saying, your trades are losing so much money that your account is about to go negative. You need to send us more cash right now or we're closing everything.
It's the most feared phone call in trading. And this client, he needed to come up with $10 million.
$10 million.
In cash. And he had to do it within an hour.
And did he?
He wired it. The money just appeared. Hougaard did the math in his head and figured out that on his salary at the time, it would take him 133 years to earn $10 million.
When you're dealing with numbers like that every day, money just stops being money, right? It just becomes a number on a screen, a score.
It has to, otherwise you'd go insane. But in the middle of all this action, Hougaard uncovers what he calls a dirty little secret of the industry. It's something that everyone who consumes financial news needs to understand.
The broker myth.
The broker myth, exactly. Yeah. We watch financial TV, we read the reports, we listen to the experts in sharp suits, and we assume, naturally, that these people are masters of the market. We think they know where things are going.
I mean, it's their job, isn't it? To be an expert.
Their job is to sound like an expert. Their job is to generate commissions, to get clients to trade, to sell financial products. But Hougaard says it point blank. Most of them do not trade with their own money.
So they have no skin in the game.
None. And because of that, their advice is often based on normal thinking, not trading thinking. And it can be absolutely terrible advice.
He has the perfect story to illustrate this, the Marconi story. This one really stuck with me because it exposes that supermarket mentality that we all fall for.
It's a brilliant example. So Marconi was a huge British telecoms company, a blue chip stock, part of the FTSE 100 index, a company you'd think was safe as houses.
And during the dot-com boom, its stock price went to the moon. It was trading at over 1,200 pence per share.
Then the bubble burst, and Marconi started to crash. And it didn't just dip, it plummeted. It fell from 1,200p all the way down to 450p.
So it's lost well over half its value. Now, the normal person, the average investor, looks at that and thinks, what?
They think, it's on sale.
Exactly. It's cheap. It used to be 1,200, now it's only 450. It's a bargain. It has to go back up eventually.
That is the universal human instinct. A client calls Hougaard, who was working as an analyst at the time, and asks him, do you think Marconi is cheap enough to buy now?
And Hougaard, who is starting to understand how markets really work.
He's starting to understand momentum. He looks at the chart and sees a dying company. He tells the client, Marconi's garbage, don't touch it. Why would you buy something that is clearly in a death spiral?
I can't imagine his boss was too happy to hear that.
Oh, his boss was furious, gave him the death stare from across the room, because you have to remember, the firm makes money when clients trade. Telling a client a stock is garbage is bad for business.
And the clients who already own it, they don't want to hear that. They want to be told it's going to be okay.
They want reassurance. They want you to say, don't worry, it's just a healthy correction before the next leg up. But Hougaard then explains the analogy that is so important.
The supermarket versus the stock market.
It's perfect. He says, look, if you go to Tesco and your favorite brand of toilet paper is 50% off, what do?
You buy all of it.
Yeah.
You load up the trolley.
Of course.
Right.
Because the intrinsic value of the toilet paper hasn't changed. It still does what it's supposed to do. It's a genuine bargain. But a stock is not toilet paper.
Right. A stock is a claim on a company's future earnings.
Exactly. And if a stock's price has fallen by 70%, the market isn't offering you a bargain. It's screaming a warning at you. It's telling you that the company's future is in serious doubt.
It's not a sale. It's what traders call a falling knife. And if you try to catch it,
You get hurt. And what happened to Marconi? It didn't bounce back to 1200. It went to zero. The company completely collapsed.
so Hougaard was 100% right.
He was. But here's the kicker. Being right in that way, being a realist, is bad for a corporate career. He says he was essentially fired from that job for being too negative. In that world, being optimistic and generating commissions is more valued than being correct.
But for a trader, being correct, or at least avoiding being catastrophically wrong, is the only thing that matters.
It's survival.
So trying to be the hero who buys the absolute bottom is a fool's game. But people love the idea of having that one clever insight that nobody else sees. Which brings us to the tragedy of the hot dog in Paris.
Oh, this story is a masterpiece. It's like a cautionary tale in 3 acts. It's about a client of his, a successful businessman he calls the Englishman.
He owns a printing company or something. He's not a finance guy.
No, not at all. He's on holiday in Paris with his family. They're near the Eiffel Tower, and he buys a hot dog for his kid. And he's just shocked, absolutely appalled by how much it costs.
We've all been there. The tourist trap pricing.
Right. But he doesn't just complain about it. He gets an idea. He starts going into French supermarkets and looking at the prices of everyday items. Milk, bread, eggs, and he's comparing them in his head to the prices back home in London.
And he realizes everything is way more expensive in Paris.
Drastically. And from this simple observation, he forms a huge macroeconomic thesis. He concludes that the French franc must be overvalued against the British pound. The theory of purchasing power parity.
That's actually pretty smart. He's doing real-world fundamental analysis.
It's brilliant. So he goes back to London, marches into the brokerage, and puts on a massive bet against the francs.
And he was right.
He was spectacularly right. The market moved heavily in his favor. He turned his initial deposit of £5,000 into a profit of £8 million.
Okay, let's just hang on that for a second. 5,000 into 8 million, that is the dream. That is the story that gets plastered all over Instagram. That is why people get into this game. It's intoxicating.
It is. It's the ultimate validation. My simple hot dog observation beat the entire global banking system. He must have felt like a king.
But the story is in a book called Best Loser Wins, so I have a feeling it doesn't end with him on a yacht.
It does not. He lost all of it.
All 8 million.
Every single penny. And then he lost more on top of that and ended up in debt.
But how is that even possible? You're up 8 million pounds.
Yeah.
Just stop.
If we stop, go home.
Because, and this is the absolute core of the book, making money and keeping money are two completely different skills.
He had the skill to find a good trade, the attack part. But he had zero skill in risk management, in emotional control, the defense part. He didn't know when to quit. The euphoria of the win made him think he was invincible.
He probably thought he couldn't lose.
Exactly. So when the market inevitably turned against him, he couldn't accept it. He saw it as a personal insult. He kept doubling down, fighting the market, convinced he was right, until all those profits were gone. And then some.
It's the Icarus story. He flew too close to the sun.
It is. And it sets up the whole rest of the book. Success isn't about that one brilliant idea. It's about having the mental discipline to handle both the wins and the losses without letting them destroy you.
Okay, so if a brilliant fundamental idea isn't enough, what about the other side of the coin? Technical analysis, the charts. You know, if I go onto YouTube right now, I can find 10,000 videos about head and shoulders patterns, double tops, Fibonacci retracements.
The whole cottage industry.
Yeah. The entire industry seems to be built on this premise that the future is written in the past, price movements. You just have to learn how to read the secret language of the charts.
And Hougaard just takes a sledgehammer to that entire idea. He calls it the elephant in the room.
What's the elephant?
He asks one simple, devastating question. If technical analysis is the key to riches, and it's what basically everyone is taught, why do 90% of the people who use it fail?
The math just doesn't work.
It doesn't. If the textbook method for building a bridge had a 90% collapse rate, you wouldn't blame the builders. You'd say the textbook is wrong.
But in trading, everyone blames themselves. They think, oh, I just didn't learn the patterns well enough. I need to buy another book. I need to go on another course.
And this leads to his story about the guru, the candlestick guru. It's both hilarious and deeply depressing.
So candlestick charts, just for context, are the standard way traders visualize price. Little green and red bars.
Right, and there are authors who have written definitive Bibles on how to interpret the patterns these candles make. Doji stars, evening stars, three black crows, they have all these exotic names.
And Hougaard meets one of these authors, a guy who was treated like a rock star at trading conferences.
He's a legend in the community.
Yeah.
So Hougaard, who at the time was still a bit of a believer, goes up to him, super excited, and asks him the question every trader wants to know. What's your favorite pattern? Which one do you trade? Which one makes you the most money?
And the guru's answer is?
The guru just laughs in his face, and he says, oh, I don't trade.
You're kidding me, he doesn't trade?
He doesn't trade. He's an author. He's a marketer. He admitted to Hougaard that he just made up cool-sounding names for random patterns because they sold books.
That is just, it's fraudulent almost.
Markets completely disillusioned Hougaard. It's like finding out that the author of the world's best cookbook can't even boil an egg. He realized the industry is full of people selling shovels and very few people actually digging for gold.
So if the patterns themselves are basically meaningless marketing gimmicks, why do we see them? I can look at a chart right now and I swear I can see a triangle forming. My brain recognizes it.
And that's the key. Your brain recognizes it. Hougaard talks about a psychological concept called patternicity.
Also known as apophenia.
Exactly. It's the human tendency to find meaningful patterns in meaningless noise. It's a survival trait.
How is it a survival trait?
Think about our ancestors on the African savanna. You're walking through the tall grass and you hear a rustle.
I'm thinking lion.
Right. You have two choices. You can assume it's a lion and run away. If it was just the wind, you look a bit silly, but you're alive. That's a false positive, a type 1 error, no big deal.
Yeah.
But if you assume it's just the wind and it turns out to be a lion, you get eaten. That's a false negative, a type 2 error, and you don't get to pass on your genes. So evolution has hardwired us to see lions in the rustling grass. We are built to find patterns, even when they're not there.
So when we look at a stock chart, which is essentially just a random walk of data points,
our brain desperately tries to impose order on that chaos. We see a head and shoulders pattern because we are biologically programmed to. Hougaard demonstrates this live with his audiences.
The colored squares experiment.
Yeah, it's brilliant. He flashes a red square on the screen. The audience shouts, red! He flashes a yellow one. They shout, yellow! Then, without warning, he flashes a stock chart. And instantly, people in the audience start shouting, buy or sell.
They can't just see it as a collection of data. They have an immediate, trained reaction.
They're not seeing the market as it is. He says, we don't see things as they are, we see them as we are. They're projecting all their past training, their hopes, their fears onto what is essentially just noise.
This also explains why things like trend lines seem so powerful in hindsight, the idea of selection bias.
Oh, this is the biggest trap for new traders. You can take any chart of any market from last week, pull out a ruler, and draw a perfectly straight line connecting the lowest points. And you say, look, a perfect uptrend. If I had just bought every time the price touched this line, I'd be a millionaire.
But you're drawing the line after the fact.
You're drawing the line after you already know the outcome. Your brain conveniently ignores the 5 other lines you could have drawn that would have failed miserably. It's a cognitive bias to make ourselves feel smart and in control.
He even goes after the most sacred of all technical tools, Fibonacci ratios.
This is like heresy in the trading world.
It is. People treat Fibonacci as if it's a law of physics. This idea that after a big move up, a market will pull back and find support at exactly the 38.2% or the 61.8% golden ratio level.
They talk about it with this mystical reverence. It's the mathematical code of the universe. But Hougaard points to a study someone did. They took years of data from major markets. They looked at every single significant pullback.
And they measured where the market actually turned around.
Exactly. And they plotted the results on a graph. If Fibonacci was real, you would expect to see huge spikes at the 38.2% and 61.8% levels.
But they didn't?
They found a completely random distribution. The 61.8% level was no more likely to be a turning point than 59% or 64%. It's just numerology. We believe it because we want to believe in some hidden order.
And there's one more big technical trap he mentions that I think is probably responsible for blowing up more retail accounts than anything else.
The overbought, oversold fallacy.
Yes. Using an indicator like the RSI, the Relative Strength Index.
This is the absolute widowmaker. The textbook tells you that if the RSI indicator on your chart goes above a certain level, say 70, the market is overbought. It's gone up too far, too fast, it's too expensive, it has to come down.
So the novice trader sees this, and they think they're being clever, They decide to bet against the trend. They sell.
They short the market, thinking they're about to catch the top. But here's the painful reality. In a powerful, sustained trend, which is where all the real money is made, a market can stay overbought for weeks, months even.
And the price just keeps grinding higher and higher.
And the trader keeps adding to their short position, getting more and more angry, yelling at the screen, but the indicator says it has to fall. They're literally arguing with the reality of the price action based on a lagging mathematical formula.
And eventually they get a margin call and get wiped out.
Every time they were trying to be right instead of trying to be profitable.
Okay, so this is a good pivot point. We've established that the gurus can be fake. The chart patterns are largely illusions our brains create, and the common indicators are traps. This brings us to the real core of the book, the psychology. If our normal mind is the problem, what is the specific mechanism inside our heads that causes us to consistently lose money?
It all comes down to our relationship with two primal forces, pain and pleasure. In normal, everyday life, our brains are wired to do a very simple thing: seek pleasure and avoid pain. If you touch a hot stove, the pain makes you pull your hand away instantly. That reflex keeps you from getting seriously burned. It keeps you safe.
Makes perfect sense.
But in trading, that fundamental wiring gets completely crossed. It short circuits. Let's walk through what he calls the retail trap, because every single person who has ever placed a trade will recognize this feeling.
All right, let's do it. So I place a trade, I buy a stock. In good news, it immediately starts going up. My account shows I'm in profit by, say, $500.
Okay. How do you feel? The first emotion is pleasure, right? I was right. I'm making money.
Yes, a little rush of dopamine. I feel smart.
But what's the next emotion that kicks in almost immediately after the pleasure? Be honest.
Anxiety, fear.
Fear of what?
Fear that it's going to disappear, that the market will reverse and take that $500 back. It feels fragile.
Exactly. You feel fear when you are winning. So what does your pain avoidance instinct tell you to do to get rid of that fear?
Lock it in. Sell the trade. Take the $500 off the table so it's real.
You snatch the small profit. You get that little hit of instant gratification, and the anxiety goes away. You've sought pleasure and avoided the potential pain of the profit vanishing.
Okay, I see that. Now let's do the other side. I buy the stock, and it immediately drops. Now I'm down $500.
Okay, now you feel pain. A real, tangible sense of loss and regret. I'm an idiot. I made a bad decision. Your brain wants that pain to stop. What's the easiest way to make it stop?
Well, if I sell, I make the loss real. That's the ultimate pain, so I guess I just hold on.
You hold on. And what emotion are you using to justify holding on to a losing position?
Hope.
Hope. You are literally replacing the painful reality with the pleasurable fantasy of hope. You tell your stories, oh, it's just a temporary dip. It's bound to bounce back. I'll just wait for it to get back to where I bought it, and then I'll get out.
I have had that exact thought 1,000 times.
Everyone has. So let's recap the psychological wiring. When you are winning, you feel fear, so you cut your profits short. When you are losing, you feel hope, so you let your losses run.
That is the exact, complete 180-degree opposite of what you should be doing.
It's the perfect recipe for financial ruin. You are mathematically guaranteed to fail over the long run. You are cutting your beautiful flowers and carefully watering your weeds.
So this is where the title comes from. Best loser wins. The philosophy is to completely invert that instinct.
A total inversion of your human nature. He calls it the 1% rule, because this is what the tiny percentage of successful traders do. They have managed to rewire their brains. They are hopeful when they are winning.
They hope the trend goes even further. They let their profits run.
And they are fearful when they are losing.
They're afraid a small loss will turn into a huge one, so they cut it immediately without hesitation.
That is the entire secret in a nutshell. It sounds so simple on paper, but in practice, fighting your own survival instincts in real time with real money on the line, it is the hardest thing in the world.
So when Hougaard says, I am an outstanding loser, it's not self-deprecating. It's a statement of profound skill.
It's his greatest strength. He wears it as a badge of honor. He has conditioned himself through years of pain and practice to take a loss without his heart rate going up, without any emotional attachment, without any desire for revenge against the market.
He uses the coin flip analogy to get this mindset across.
It's a great mental model. If I tell you we're going to flip a coin 100 times, intellectually, that the outcome will be roughly 50 heads and 50 tails.
Right. It's just probability.
So if the first 3 flips are tails, you don't get angry at the coin, do you? You don't think the coin is broken or that the universe is rigged against you?
No, of course not. I know that heads are coming eventually.
Exactly. You accept the short-term randomness because you trust the long-term probabilities. A professional trader views their trading system the same way. A single losing trade is just a tails. It doesn't mean the system is broken.
Whereas the novice trader aces their entire self-worth on that one flip.
Yes. They get a loser and they think, I'm a terrible trader, my system is garbage. They immediately start changing everything. The professional just sees the loss as an operational cost. It's the price of admission. It's like a shop owner having to buy inventory before they can sell it. Losses are the cost of doing business in the markets.
That is a massive, massive shift in perspective to detach from the outcome of any single trade.
It's everything. But then Hougaard takes it to another level. And this, for me, is the part of his strategy that is the most psychologically challenging. It's terrifying, actually.
Adding to your winners.
The Johannesburg Epiphany, as he calls it.
Yeah.
He's at a trading workshop in South Africa, and one of the speakers says something that just shatters his worldview. The speaker says that when a trade is working, when the market is proving you right, that's when you should have your biggest size on.
Okay, so normal behavior, my behavior, would be, great, this trade is in profit. I should probably take some of that profit off the table to reduce my risk. Be safe.
That's what 99% of people do. But the winning behavior, the Hougaard logic, is the market is agreeing with me. It's validating my thesis. This is a high probability situation. I should buy more.
But that's so scary. If I have a profit and I add to the position at a higher price, I'm raising my average entry cost. If the market suddenly reverses, I could lose all my profit and even go negative in a heartbeat.
That's the fear talking again. That's the normal brain screaming at you to protect what you have. But look at it with cold, hard logic. You want your biggest bets on your best hands, right?
Of course.
So if you buy a stock and it immediately drops, you follow your rules and get out. It's a small loss on your initial small position, no big deal. But if you buy a stock and it starts to run higher, you add to it. Then it goes higher still, you add again. Now, your biggest position size is on a trade that is strongly confirming that you are correct.
So your winning trades become exponentially larger than your losing trades.
That's how you get those huge outlier days. That's how he has days where he makes 100,000 pounds or more. He's not predicting the future any better than anyone else. He's just incredibly aggressive when he's right and incredibly quick to admit when he's wrong.
So how on earth do you train yourself to override decades of instinct and do that? It feels impossible. He must have some practical tools.
He does, and they're not easy. The first one is what he calls the Book of Truths.
It sounds ominous.
It's basically a form of aversion therapy for your trading mistakes. He says you need to take screenshots of your worst trades, the really painful ones, the ones where you broke all your rules, where you got emotional, where you held a loser all the way down.
And what do you do with them?
You print them out. You paste them into a physical notebook or make a PowerPoint presentation of your failures, and every single morning before the market opens, you force yourself to look at them.
Well, that sounds awful.
It's supposed to be awful. You need to relive the feeling of disgust and shame you felt when you made that mistake. The goal is to create a powerful, negative emotional association with that bad behavior. You want to train your brain to recoil from the idea of moving your stop loss, just like you recoil from touching a hot stove.
It's such brutal self-honesty. Most of us just want to forget our mistakes and move on. He's saying you need to stare at them until they're burned into your memory.
Exactly. He warms up for the trading day by reminding himself of all his personal flaws as a trader, so he's on high alert not to repeat them.
And then when the market actually opens, he has a ritual, this idea of flipping the switch.
Yeah, he uses the analogy from the movie Gladiator. Before a fight, Maximus Decimus Meridius bends down and rubs dirt on his hands.
It's a trigger, a ritual to get into character.
It's a trigger. It's a signal to his brain that it's time to transform. Hougaard says you cannot be the same person in the market as you are in your daily life. You can't be Tom the nice guy who helps his neighbors or Tom the patient father. Those personas are too soft, too emotional, too forgiving.
They get you killed in the market.
They will. So you need a ritual. Maybe it's putting on a certain playlist or drinking a specific coffee or just a mental exercise that helps you flip the switch and become the trader. A cold, disciplined, objective machine that just executes a plan.
It's about a clear separation of your identities and a focus on the process, not the outcome.
That is the final piece of the puzzle. If you sit down at your desk and your goal is, I need to make $1,000 today, you are absolutely doomed.
Why?
because you're focused on the outcome, which you cannot control. You'll start forcing trades that aren't there. You'll chase the market. You'll take too much risk out of desperation.
So what should the focus be on?
The process, the things you can control. Your goal should be, today, I will follow my rules perfectly. I will wait patiently for my specific setup. I will cut my losses at my predetermined level. I will add to my winners if the opportunity arises. If you execute the process flawlessly, the money just becomes a byproduct. The outcome takes care of itself.
It all comes back to this idea that trading isn't really you against the market, it's you against yourself.
The market is just a giant mirror. That's all it is. It doesn't care about you, your mortgage, or your ego. It just reflects your own psychological state back at you with ruthless honesty. If you're impulsive, it will punish you. If you're greedy, it will punish you. If you're fearful, it will punish you.
But if you can achieve that state of mental discipline, that self-mastery,
then the market transforms from a battleground into a field of infinite opportunity.
it leaves us with a really fascinating thought, doesn't it? And it applies to so much more than just trading. In any area of life, are we more focused on being right, on defending our ego and avoiding the short-term pain of admitting a mistake? Or are we focused on being successful, which often requires us to become an expert at taking small losses, learning from them, and moving on quickly?
That's the billion-dollar question, isn't it? Are you trying to be right, or are you trying to be paid?
Huge thanks to Tom Hougaard and his book, Best Loser Wins, for the insights. It's a masterclass in psychology. Thank you for watching, Hull. Please like, say, share, subscribe, follow, but next topic. Come back to continue Best Loser Wins.
It is good to be back. And today, we are tackling a massive topic. A beast of a topic, really.
We really are. We're diving deep into Best Loser Wins, Why Normal Thinking Never Wins the Trading Game by Tom Hougaard. I have to be honest with you, just reading the title gave me a bit of a pause. We're conditioned our entire lives, from the playground to university to the corporate ladder, to think that winning is about, well, winning.
Being right.
Being the best, being right, being the smartest person in the room. And here comes this guy saying, no, actually, the secret is being good at losing.
It's a provocative title, isn't it? It sounds almost defeatist at first glance. But when you peel back the layers, as we're going to do today, it's probably one of the most accurate, piercing descriptions of what high-level trading actually entails.
And it's important to establish who this guy is. He's not some academic, right?
Not at all. And that's critical. Tom Hougaard isn't writing this from an ivory tower. He isn't some theorist.
Right. He's in the trenches.
Deep in the trenches. This is a high-stakes day trader. We're talking about someone who has traded with sizes up to 3,500 pounds per point.
Okay, let's just pause on that for a second. 3,500 pounds per point. So if the market moves, 10 points against him, which can happen in a heartbeat, he's down 35 grand.
Instantly. Yeah. 35,000 pounds gone. He risks sums of money on a Tuesday afternoon that most people save for years to accumulate. So when he talks about the psychology of loss and the pressure of the markets, he isn't guessing. He has lived it.
That is just mind-boggling pressure. I mean, I get anxious if I lose a $20 bill. I can't imagine that level of swing.
It's intense, but his core argument, and really the mission of this deep dive, is to understand a very specific, very terrifying statistic. Why do 90% of traders fail?
90%. It's staggering.
Why do the vast majority of people who enter the markets lose money? And his answer isn't that they don't know how to read a chart. It isn't that they don't understand, the RSI indicator or Bollinger Bands.
So it's not a technical skill gap.
No. His argument is that they fail because they're normal.
Normal? What does he mean, normal?
Normal. He argues that normal human behavior, the kind of thinking, the biological wiring that keeps you safe, happy, and functional in everyday life, is the exact root cause of financial ruin in the markets.
That is a heavy concept.
Yeah.
So to be a winner in the market, you effectively have to be, abnormal?
In a sense, yes. You have to be an anomaly. You have to rewire your biology to act against your most basic instincts.
Okay, let's unpack this. Because that statistic you mentioned, the 90% failure rate, and sometimes I've seen it cited as high as 99% depending on the time frame. It's terrifying.
It is.
If you went to a dentist and there was a 90% chance they'd pull the wrong tooth, or a surgeon with a 90% mortality rate, you'd never sit in the chair. You'd run for the hills.
Precisely. Hougaard points out that trading is the only profession with such a catastrophic failure rate that people still flock to in droves. And the reason they fail is what we can call the normal paradox.
The normal paradox.
Think about your daily life. In normal life, avoiding pain is rational. If you touch a hot stove, you pull your hand away. That's a survival mechanism. It's good.
Of course.
If you're walking down a dark alley and feel fear, you turn around. That keeps you alive.
Right. That's just common sense, self-preservation.
But in trading, that reptile brain, the part of you that screams, avoid pain, seek safety, is your worst enemy. It is the saboteur.
Because the market doesn't care about your pain.
The market is an inanimate object. It's a collection of orders. It has no feelings, no morality, no memory of your last trade. But you do. And the central thesis here, the title of the book, is that the best trader isn't the one who predicts the future. It isn't the one who wins the most often.
It's the one who is the best loser.
The one who's the best loser. The one who can take a loss without falling apart mentally.
I love that concept. Even though it goes against everything we're taught, it just flips the whole script. Instead of trying to be a fortune teller, you focus on how you handle it when you're wrong. And we've got so much to cover today to explain how to do that. We're going to look at the conflict inside our own heads, this idea of fighting our humanness. We're going to talk about disgust as a superpower, which I found to be one of the most unique takeaways from his work.
Oh, that section is brilliant.
Then we'll get into the drifter mind, the reality of handling slumps without going broke, and the counterintuitive art of losing well.
It's going to be a journey into the psychology of the self as much as it is about trading. I think if you listen closely, you might find this applies to a lot more than just the stock market.
So let's jump right into that first major theme, fighting my humanness. This sounds like a sci-fi movie title or maybe a philosophy lecture, but it's actually about neurology, right?
It's rooted in how our brains are built. Hougaard talks about the conflict of two minds. You have your logical mind, the neocortex. This is the part of you that's smart. It learns strategies, understands math, makes plans, reads books.
The CEO of the brain, the part that's listening to this deep dive right now.
That's the one, the you that thinks it's in charge. But then you have the reptile brain, the amygdala. This is the ancient part of the brain responsible for survival. Fight or flight. Eat or be eaten.
The part that sees a saber-toothed tiger and says, run, before you've even consciously processed what you're looking at.
Precisely. The reptile brain's primary job is to keep you safe and, crucially, to avoid pain. Now, apply that to a trading screen. You enter a trade, you bought Apple stock, suddenly it drops, you're losing money. That red number on the screen, that's pain.
To the reptile brain, it's a threat, a predator.
It's a threat to your resources, which to that ancient part of your brain is a threat to your survival. So your reptile brain kicks in and wants to avoid the reality of that pain.
So it goes into denial. This isn't happening.
It goes into what Hougaard calls the hope and fear inversion. This is so critical to understand because it explains why smart people do incredibly stupid things with their money. The normal trader, the 90% who lose, has their wires completely crossed.
How so? Walk us through the feeling.
Think about it. When a normal trader is losing money on a trade, what do they feel? They're sitting in a loss. The reptile brain says, if you sell now, you make the pain real. You lock in the loss. Don't do that.
So you avoid it.
And instead, you feel hope. You hope the market will turn around so you don't have to realize the loss and feel the pain of being wrong. You hold on to a bad position, praying it comes back to break even.
I think we've all been there, not just in trading, but in life. Oh, it'll get better. Just give it time. Maybe she'll call. You bargain with reality because the alternative is admitting defeat.
Right. But in the market, giving it time when you're wrong just drains your account. The market doesn't care about your hope. It's not a person.
Okay, so that's the losing side. Hope. What about winning?
So now you flip the scenario. What happens when that same normal trader is winning? They see a profit on the screen. Green numbers.
Joy. Excitement. A feeling of, I told you so.
Initially, yes, for a moment. But very, very quickly, that turns into fear. They are terrified that the profit will disappear. They're scared the market will take it back. They think, I better grab this now while I can.
So the reptile brain is screaming, grab the food before another animal takes it.
100%. It's that bird in the hand logic. So what do? They snatch the profit. They close the trade way, way too early.
So they hold their losers because they hope, and they cut their winners because they fear.
Exactly. And that is a mathematical recipe for bankruptcy. You're capping your wins, taking 5 points here, 10 points there, and you're letting your losses run uncapped, hoping they turn around. Eventually, one of those losses becomes a catastrophe.
So the winning trader has to flip that.
Completely invert it. You must be fearful when you're losing, fearful that a small loss will become a big one, so you cut it instantly. And you must be hopeful when you're winning, hopeful that the trend will continue, so you let it run.
That is so counterintuitive. It's like trying to write with your non-dominant hand. It feels wrong, deeply wrong, even if you know it's the right thing to do. Your body is screaming at you to take the profit.
It feels wrong because you're fighting millions of years of evolution. Biology wants you to grab the food, the profit while it's there, and avoid the predator, the realized loss. But the market punishes that biology. It rewards the abnormal.
Hougaard uses this great analogy about the supermarket versus the financial market. I thought this was just brilliant because it explains why we love bargains.
Yes, the supermarket paradox. This is something everyone can relate to. In our daily lives, we're trained consumers. We're hunters of value. If you go to the store and your favorite brand of toilet paper is 50% off or a steak is half price, what do?
You stock up, you buy 2 packs, you text your partner, hey, great deal on steak.
Yeah.
You feel smart. You feel like you've beaten the system.
Exactly. We are wired to buy cheap. We see a lower price as value. We think we're getting more for less. But when you apply that logic to a stock or a currency pair, it is absolutely disastrous.
Because if a stock falls 50%, it isn't on sale, like toilet paper.
No, toilet paper is still toilet paper. Its utility hasn't changed.
It still does the job.
Correct. But a stock that falls 50%, it's crashing. The underlying company might be in trouble or the macroeconomic environment has shifted. There is a reason it's down. The market is telling you it's weak.
But our brain sees the chart dropping and thinks, oh, it's a bargain now. It was $100 yesterday, now it's $80. I should buy.
That is called catching a falling knife. And you're trying to apply consumer logic where price equals value to a momentum-based environment. In the market, price equals, well, price. If it's falling, the momentum is down. Buying it because it's cheap is betting against the reality of the market. You're standing in front of a freight train because you think the train ticket is on sale.
And the worst part is sometimes it works, right? Like sometimes you buy the dip and it bounces back, and that feels amazing.
That is actually the most dangerous thing that can happen to a novice trader. It's catastrophic.
Wow, you made money.
Because if you catch a falling knife and you survive, maybe you even make money, you've just been rewarded for bad behavior. Your brain says, aha, that worked. I'm a genius contrarian. So you do it again and again. It creates a neural pathway that says buying falling assets equals reward.
Until one time it doesn't bounce.
Until eventually you catch a knife that just keeps falling. And because you're used to it bouncing, you hold on. And it cuts your hand off. It leads to a blow up.
It creates this pattern of bad habits. And I imagine this leads to a lot of internal conflict. You know, you shouldn't hold the loser, but you do. The logical brain is saying sell, and the reptile brain is saying hold.
That is cognitive dissonance. It's the mental stress of holding two conflicting beliefs. I am a smart, disciplined trader, and I am currently losing a lot of money and refusing to close the trade.
So your brain has to resolve that conflict somehow.
It has to. To resolve that stress, the subconscious mind creates excuses. It creates narratives. Hougaard calls it the table of excuses.
I loved this part of the source material.
Yeah.
It was like he was reading my diary. He breaks down the conscious reason versus the subconscious reality. It's brutally honest.
It's savage. Let's look at a few. The conscious reason might be, I'm letting this loss run to give the trade some room to breathe. I don't want to get stopped out by market noise. Sounds logical, right? Very professional.
Totally. I'm just giving it space. Sounds very pro.
But the subconscious reality is, I am avoiding the pain of admitting I was wrong. I am paralyzed by the fear of realizing this loss.
Ouch. That hits home.
Or how about this one? Conscious reason. I made my target points for the day, so I'm closing up shop. Slow and steady wins the race. Sounds disciplined.
Very responsible.
Subconscious reality. I am afraid to lose what I have already made, so I'm running away before the market takes it back.
That is the fear of losing the profit again. It's just rationalization. Wow. We are so good at lying to ourselves.
It's the ego protecting itself. We construct these elaborate narratives to avoid saying 3 simple words, I was wrong. Because for the ego, being wrong is painful. It implies stupidity or failure.
But in trading, being wrong is just feedback.
It's a cost of doing business. It's like a restaurant buying food. Some of it will spoil. You don't take it personally when a tomato goes bad. You throw it out and move on.
We have this biological wiring that is actively trying to sabotage us. We have the normal mindset that seeks comfort and avoids pain. The question is, how do we break that? How do we actually change? Because willpower, as we know, usually runs out around Wednesday afternoon.
Right. And that leads us to the concept of disgust.
Yes, disgust as a catalyst.
It's strong language, isn't it?
It is. It's meant to be. Usually self-help books talk about passion or desire or visualization of success. They tell you to put a picture of a Lamborghini on your vision board. Hougaard is taking a completely different angle here. He's talking about being disgusted with yourself.
He argues that positive thinking and sticky notes on your monitor saying, be disciplined or follow the plan, are just not enough. They're too weak. They're like trying to stop a charging rhino with a feather.
They can't override the reptile brain.
Not when the pressure is on. He says humans are motivated by two main forces: moving towards pleasure or moving away from pain. Hougaard found that moving away from what disgusts him was a far, far more powerful motivator than moving towards a reward.
He uses the rotten milk analogy, which I found really stuck with me.
It's visceral. Imagine you go to the fridge, you're thirsty, you grab a carton of milk and take a huge swig. But it's spoiled. It's chunky, sour, absolutely vile.
Ugh, I can taste it just thinking about it. My stomach just turned.
Exactly. You gag, you spit it out. It ruins your morning. Now, here's the key. For a long time afterwards, months, maybe years, what do you do every time you grab a milk carton?
You sniff it. You check the date. You pour a little bit in a glass first. You are hypervigilant.
And do you need a sticky note on the fridge saying, remember to check the milk?
No, absolutely not. You do it automatically. It's burned into your brain.
Because the disgust created a permanent behavioral change. The memory of that bad taste is so strong that your body physically prevents you from making the mistake again.
So he needed to feel that way about his bad trading habits.
He needed to reach that point with his trading. He describes his own personal transformation. He was stuck in this cycle. He would trade like a wizard for a while, build up the account, get overconfident, and then boom, blow up the account, lose it all.
The classic boom and bust cycle. It's heartbreaking because you see the potential, but you keep self-sabotaging.
And he realized he couldn't just try harder. He had to become physically disgusted with his own lack of discipline. He had to look at his reckless behavior and find it as repulsive as that rotten milk. He had to stop seeing his lack of discipline as a quirk and start seeing it as a character flaw that was destroying him.
And he did this through something he calls the Book of Truths. Now, this sounds like a torture device for the ego.
In a way it is. It's a practical exercise, and I highly recommend listeners pay attention to this if they want to get serious. He didn't just look at his P&L statement, which creates a sort of abstract number. He printed out the charts of every single trade he took.
Physically printed them.
On paper.
On paper. He marked the entry and the exit with a pen.
So he had to physically look at the chart where he bought the top and sold the bottom. He had to look at the chart where he exited a winner after 5 points, only to watch it run for another 100 points without him. Yes. He created a visual hall of shame. He laid them all out on the floor. He could see the impulsive trades. He could see where he chased a loss. He could see the fear in every early exit. There was no hiding.
That must be incredibly painful to look at. It's like looking at photos of your worst haircuts, but costing you thousands of dollars.
That's the point. He wanted to strip away the vanity. He wanted to strip away the excuses of, oh, the market was choppy, or Trump tweeted something. No, the chart shows you exactly what you did. It forces an honest confrontation with your own incompetence.
He compares it to Alcoholics Anonymous.
Yes. The first step in AA is admitting you have a problem. You have to strip yourself naked, metaphorically. You have to admit you are powerless over your impulses before you can rebuild.
You have to hit rock bottom.
Hougaard says you have to look at your trading with that same brutal honesty. You have to say, I am an awful trader because I cannot control my reptile brain. Only then, when the ego is shattered, can you start to build a new structure based on discipline rather than arrogance.
It's about killing the ego to save the bank account. If you keep the ego, you lose the money.
Precisely. If you're protecting your ego, you're draining your wallet.
So, let's say we've done this. We've faced the rotten milk. We've printed out our hall of shame. We've admitted we have a problem, but there's another enemy lurking, right? Even if you're honest, the mind has a way of wandering. Hougaard calls this the drifter mind.
The drifter mind. This is the brain's natural tendency to lose focus, to seek novelty, to seek dopamine. We live in an attention economy. We are addicted to stimulation.
And trading, ironically, when it's done right, involves a lot of sitting and waiting. A lot of boredom.
Trading, when done right, can be incredibly boring. It is hours of waiting for the perfect setup, followed by seconds of execution. The drifter mind hates boring. It wants action. It wants lights and sounds and clicks.
It's like when you're supposed to be working on a spreadsheet, but you find yourself scrolling social media or cleaning the kitchen. Anything but the boring task.
Exactly. And in trading, that manifests as overtrading. You get bored, so you invent a trade. You see a pattern that isn't really there just because you want to click the button and feel involved.
You want that little hit of adrenaline.
You do. And Hougaard uses the FedEx arrow example to illustrate how our brains work in this regard.
Oh, the FedEx logo. I love this example because once you see it, you cannot unsee it.
Right. For those who don't know, look at the FedEx logo. Between the capital E and the X, the negative space forms a perfect white arrow pointing right.
But most people go years, their whole lives, without noticing it. They just see purple and orange letters.
Because the brain filters it out. It isn't essential information, but once it's pointed out to you, your brain highlights it. Every time you see a FedEx truck, you see the arrow.
So how does that apply to trading?
It shows that we see what we want to see, or we miss what's right in front of us. If you're bullish, if you desperately want the market to go up because you're bored or you need money, your drifter mind will filter out all the bearish signals, the arrow, and only show you the reasons to buy.
So you're basically hallucinating a setup.
You're hallucinating a setup because you want the dopamine hit of being in a trade. You are projecting your desire onto the screen. You're trading your imagination, not the market.
That is so dangerous. So how does Hougaard keep this drifter mind in check? He can't just will himself to focus. We've established willpower isn't enough.
He uses accountability mechanisms, radical accountability. He posts his trades live.
Live, like on social media, as he enters them.
Yes, on Telegram and other channels. He has thousands of followers watching his every move in real time.
That sounds like a nightmare. Imagine making a stupid mistake and thousands of people seeing it instantly. The judgment.
That is exactly why he does it. He emphasizes that he doesn't do this for fame or to show off. He does it because public scrutiny forces him to be disciplined. The drifter mind wants to take a silly bored trade, but the conscious mind says, if I take this stupid trade, I will look like an idiot in front of 10,000 people.
So the Shane factor keeps the drifter mind in a cage.
He's outsourcing his discipline to the crowd. He creates a firewall against impulse. If nobody's watching, it's easy to cheat on your diet. If you have to send a photo of every meal to a coach, you don't cheat. It's the same principle.
He also uses a visualization technique that I found. Well, honestly, a bit dark. Most sports psychology is about visualizing the win, right? See the ball go in the hole. You see yourself on the podium.
Hougaard says visualize failure.
Why? Would that make you negative? Wouldn't that, like, manifest a loss, the whole law of attraction thing?
No, it's about desensitization. It's a Sturdic technique called premeditatio malorum, the premeditation of evils. In the morning, before the market opens, he sits quietly and imagines losing a specific, painful amount of money, let's say the cost of a nice car.
He literally imagines burning a BMW.
He visualizes the market moving against him. He visualizes that spike of panic in his chest. He visualizes the reptile brain screaming, move the stop loss, don't take the hit.
He rehearses the disaster scenario. He lives it in his mind first.
And then, in his mind, he visualizes overcoming that urge. He sees himself taking the loss calmly. He sees himself accepting it without anger. He sees himself clicking close and moving on to the next trade.
So when it happens in real life?
He's already been there. The reptile brain doesn't panic because it's a familiar scenario. Oh, we're losing 10,000 pounds. We just practiced this 10 minutes ago. I know what to do. I execute.
It removes the shock factor.
Whereas if you only visualize winning, you're completely unprepared emotionally when you lose. And you will lose.
You will lose. It's guaranteed. It's like a fire drill. You don't want to figure out the exit route when the building is actually burning and the smoke is in your eyes. You want it to be muscle memory.
That is incredibly smart. He's inoculating himself against the emotional virus of panic.
Exactly.
But let's be real. Even with all this preparation, the disgust, the accountability, the visualization trading is hard. Sometimes the market just doesn't cooperate. Sometimes you hit a slump. And this brings us to a very serious part of the discussion. Trading through a slump. Slumps are inevitable. That's the first thing Hougaard wants us to understand. No one, absolutely no one, wins all the time. He references athletes like Roger Federer, Rafael Nadal, Kobe Bryant. Even the gods of their fields have periods where they just cannot win. They hit the net. They miss the shots.
It's comforting, in a way. If Federer can have a bad season, I can have a bad week.
It is. But the stakes in trading can be higher than a lost tennis match. In tennis, you lose ranking points. In trading, you lose your livelihood. Hougaard tells the tragic story of a trader he calls Adam.
This was a heavy part of the book. It really stopped me in my tracks.
It should. Adam was a skilled trader. He knew what he was doing. But he hit a slump. And instead of managing it, he fought it. He let the psychological pressure get to him. He started increasing his size to win back the losses.
Revenge trading. Trying to punch the market in the face.
Exactly. The slump turned into a total blowout. He lost his discipline, then he lost his capital, then he lost his wife, his house, everything. The story ends with Adam taking his own life.
It's just devastating.
And Hougaard brings this up not to be sensational, but to highlight the extreme mental fragility of this profession. If you don't manage the slump, it can destroy you, not just your bank account, but your life.
That is a stark reminder. It's not a game. And part of what makes slumps so hard, and what probably drove Adam to that edge, is seeing other people succeed while you are failing. That envy.
The envy trap. This is pure poison. Hougaard shares a personal story here to show he isn't immune. He was in a slump, losing money day after day. He felt like he couldn't do anything right. Meanwhile, his close friend, who he calls the best private trader the world has never heard of, was on a massive winning streak.
That has to sting. You're bleeding chips, feeling like a failure, and your buddy is calling you up talking about buying a new Ferrari.
It tormented him. He was short when his friend was long. The market rallied. The friend made a fortune. Hougaard took a massive loss. He felt resentment. He felt like the universe was unfair. Why him and not me?
It's the Salieri complex. Mozart is effortless, and Salieri is suffering.
Exactly. His girlfriend actually gave him that specific advice. She compared them to Mozart and Salieri. She told him that having a rival, someone better than you, is a blessing, not a curse.
How is it a blessing? It feels like a curse.
Because it proves it can be done. If you were the best and you were failing, you might think the market is impossible. You might give up. But seeing someone else win proves that the market is beatable. It forces you to be better. It forces you to ask, what is he doing that I'm not?
So it transforms envy into curiosity.
Exactly. It reframes it from a personal failure to a puzzle to be solved.
That is a powerful reframe. So, practically speaking, how does Hougaard say we should handle a slump? When we're in that dark place, losing money, feeling dumb, do we stop trading?
This is where he diverges from standard advice. A lot of trading coaches say, if you lose 3 trades, take a week off, go to the beach, clear your head. Hougaard says, don't stop.
Really? Just keep trading. That sounds so risky.
There's a major caveat. If you're emotional, if you are crying, smashing keyboards, throwing things, or deeply depressed, then yes, stop immediately. You are compromised. You are a danger to yourself.
Okay, that makes sense.
But if you're just losing because of market variance, if you are calm but the trades just aren't working, you should keep trading. But you must slow down.
What does that mean, slow down?
It means focusing entirely on the process, not the outcome. Forget the P&L. And most importantly, trade smaller. Much, much smaller.
Ah, the betting size. This is where the paradox comes in.
Yes. There is a famous quote from a floor trader named Greg Reba. He said, when they are winning, they start betting less. Bet more.
Wait, explain that.
Most people, when they're in a slump, what do? They want to make the money back now, so they double their bet. If I just win this one big trade, I'm back to even.
The martingale strategy. Doubling down on a loss?
Which leads to absolute ruin. The correct move in a slump is to decrease your size drastically. If you usually trade 100 pounds a point, drop to 10. Survive the slump. Keep your hand in the market, keep reading the price action, but protect the capital.
Okay, so schwenk when losing.
But, and here's the Reba point, when you are in a winning streak, when you're seeing the ball perfectly, that is when you press the accelerator. That's when you should bet more.
And most people do the opposite.
Most people do the exact opposite. They bet big when losing out of desperation and bet small when winning out of fear of losing the profit.
It always comes back to that inversion, doing the opposite of what feels natural. You have to feed the winning streak and starve the losing streak.
Always. You have to earn the right to trade big.
This leads perfectly into the next section, embracing failure. Because if you're going to trade through a slump, you have to be okay with failing. You have to make friends with it.
You have to reframe failure entirely. In school, failure is bad. It means you didn't study. It means you get an F. In trading, failure is just information. It's feedback. It's the market telling you, not now or not this direction. It's not personal.
Hougaard uses the Kobe Bryant example again here, the Air Bowl game. I think this is such a defining story for a winner's mindset.
It's legendary. In his rookie year and a crucial playoff game against the Utah Jazz, Kobe Bryant shot 4 air balls.
4. Not just missed shots, air balls. He didn't even hit the rim, in the clutch.
In front of millions of people. The Lakers lost the game, the fans jeered him, the media destroyed him. It was a total public humiliation for a teenager.
Most people would hide under a rock. They'd never want to shoot the ball again. Their confidence would be shattered.
What did Kobe do? He went straight from the arena to a local gym. He stayed there until the sun came up, shooting hundreds and hundreds of shots. He didn't let the failure define him. He let it drive him. He was willing to fail publicly in order to succeed eventually.
And Babe Ruth, too. We remember the home runs. We don't remember the strikeouts.
That's right. Babe Ruth held the home run record for decades. But do you know what other record he held for a very long time?
Strikeouts.
The king of strikeouts. You cannot hit home runs if you are afraid to swing and miss. The normal person is so afraid of the strikeout, the embarrassment, the failure, that they never swing the bat hard. They keep the bat on their shoulder, they stay safe, and they never win.
Hougaard talks about the 50-50 coin flip mentality. This seems crucial for accepting the randomness of it all.
It's the bedrock of his psychological stability. He views every trade like a coin flip. Now, listen carefully to this logic because it's so freeing. If you flip a coin once, what's the outcome?
It's random. Heads or tails. 50-50. You can't know.
You cannot predict it. It's chaos.
Yeah.
But if you flip that coin 1,000 times, what do you know for a fact?
It will be roughly 500 heads and 500 tails. It's a statistical certainty over a large sample size.
Exactly. The outcome of the macro is predictable, even if the outcome of the micro is random. Hougaard treats trading the same way. He knows his ed works over 100 trades. So the outcome of this specific trade...
He doesn't care.
He doesn't care. It's just one flip. It's meaningless. The normal trader treats every single trade like it's a judgment on their soul. If it loses, they feel stupid. If it wins, they feel like a genius, Hougaard says. Detach. The outcome of this specific trade is random noise. I don't care about this one. I care about the outcome of the next 100 trades.
That is incredibly liberating.
The ideal mindset, he calls it, one that accepts randomness and therefore feels no pain when a loss happens.
And this leads to his boldest claim, a quote that I think sums up the entire book. I am an outstanding loser.
I am an outstanding loser. Just let that sink in.
He wears it like a badge of honor.
He says his edge isn't technical analysis. He says anyone can learn support and resistance in a weekend. Anyone can read a chart. His edge, the reason he drives the nice car and lives the life he lives, is that he can lose without anxiety. He can lose without emotional attachment. He can lose without resentment.
I want that on a t-shirt. Outstanding loser. It's the ultimate flex in trading.
It really is. It means the market cannot hurt you. Your ego is not on the line.
Okay, we've covered the philosophy, we've covered the psychology, the neurology, the biology. Now let's get into the mechanics. The how-to. This is section 6. Best loser wins. How do we actually flip the switch? What are the specific rules he follows?
Right. This is where it gets very practical. Hougaard gives us specific rules to override that 90% failure rate. And I want to spend some real time here because this is where the rubber meets the road. Rule number 1. Assume you are wrong.
Wait, assume you are wrong. That sounds so counterproductive. Don't you enter a trade because you think you're right. I think gold is going up, so I buy gold.
That is how most people think. They enter loaded with positive expectation. They think, this is the one. This is going to the moon. I'm going to pay off my mortgage with this trade.
And what's wrong with that? Optimism is good, right?
In life, maybe. In trading, it's poison. Because if you assume you're right, you are shocked when the market goes against you. You freeze. You think the market is wrong. It should be going up. You go into denial.
You are prepared for the loss. It's a surprise attack.
Exactly. Hougaard enters every trade expecting it to fail. He thinks, this probably won't work. So he has his finger on the sell button immediately. If it goes against him, he's like, yep, thought so. And he cuts it instantly. No hesitation. He's protected because he was expecting the hit.
It lowers the stakes mentally. He's defensive. But if it works...
But here's the magic. If the trade goes for him, he's pleasantly surprised. Oh, look at that. It's working. He's never disappointed, only surprised. It completely flips the emotional landscape of trading.
That is a fascinating psychological trick. Okay, rule number 2.
Rule number 2. Expect to be uncomfortable. He says if a trade feels comfortable, it's probably wrong.
That goes against everything we want. We want comfort. We want certainty. We want to feel safe.
If a trade feels comfortable to you, oh, everything looks safe, the news is good, it feels comfortable to everyone else, too. It's a crowded trade. Everyone has already bought. Who's left to buy? Usually the best opportunities are the ones that feel scary.
Like buying when the world is ending or shorting when everyone is euphoric.
Exactly. But the most uncomfortable thing, and this is the absolute key to high-stakes success, is adding to winners.
We touched on this earlier, but let's drill down. Why is this so uncomfortable?
Imagine you buy a stock at $100. It goes to $120. You have a $20 profit per share. Your reptile brain is screaming, "Take the money, it's safe. Don't let it go back to 100."
Right. You want to bank it, protect the profit.
Hougaard says, "No, buy more at 120.
But if I buy more at 120, I'm raising my average price. If it drops back to 110, I lose my entire profit. I'm risking the money I just made.
Exactly. You are risking paper profits to chase a bigger trend. It is terrifying for the normal mind. It feels like burning money. But think about the math. If you only have one unit and the stock goes to 200, you make $100. If you add another unit at 120 and another 140 and another at 160, when it hits 200, you've made exponential returns.
You are pyramiding into the strength.
You are pressing the advantage. The losers take small profits and hold big losses. The winners take small losses and hold and add to massive wins. It is the only way to catch the huge moves that make a career.
But it requires a stomach of steel. Because if it turns around, you lose more.
Which is why you have to be good at losing. If it turns around, you cut it all. You take a small profit or a break-in. You don't let it turn into a loss. You protect the downside aggressively.
And the cardinal sin, the thing you must never, ever do.
Never add to losers. Never. Not once.
But it's so tempting.
Yep.
I bought at 100, now it's 80. If I buy more at 80, my average is 90. I only needed to go to 90 to break even.
That is averaging down. That is digging a hole. It's pure hope. You are adding exposure to a position that the market has already told you is wrong. It is the fastest way to blow up an account.
So the rule is simple.
Hougaard is adamant. If it's red, you reduce or get out. If it's green, you consider adding. Normal people do the opposite. They add to the red to fix it and cut the green to save it.
He tells a story about Paul Tudor Jones that perfectly illustrates this lack of attachment.
Oh, it's a classic. Paul Tudor Jones, one of the greatest macro traders ever, a billionaire. He was long the market, heavily invested, bullish.
He thought it was going up. He'd put his money where his mouth was.
The market suddenly dropped. Hard.
Panic time.
For a normal person, yes. Joan immediately sold everything. He went flat, he got out, no questions asked. And then realizing the market was actually weak, he immediately went short.
He flipped 180 degrees in seconds.
He had zero emotional attachment to his opinion from 5 minutes ago. He didn't care that he was a bull in the morning. He didn't care about being right. The price action said down, so he became a bear. Most people can't do that. Their ego is wrapped up in their opinion. I said it would go up. I can't sell now. I'll look stupid. Jones just wanted to be on the side of the money.
That is true fluidity. It's like water. No shape. Just flow with the current.
And that leads to the final definition. Best loser wins means conditioning the mind to lose without loss of mental equilibrium.
Without losing your cool.
Yeah.
Without tilting.
It's about resilience. It's about doing the hard things, cutting the loss when it hurts, adding to the winner when it's scary, because you know that is the only way to beat the normal instincts that lead to failure.
So what does this all mean for us? For the listener who might be trading or maybe just struggling with discipline in another area of their life?
It means that success, real success, comes from conquering your own biology. It is not about mastering the external world, the charts, the news, the noise. It is about mastering the internal world, fighting the urge to seek comfort, fighting the urge to avoid pain.
It really is a battle with yourself, isn't it? The market is just the arena.
The market doesn't care about you. It doesn't know you exist. It isn't trying to hurt you. It isn't trying to help you. It's just a mirror. It reflects your own discipline, or lack thereof, back at you. Your struggle is never with the market. It is always a battle with your own nature.
And if you can master the art of losing, if you can remove the power fear has over you, then you've won. Not just in trading, but in everything.
That is the ultimate freedom, to be unafraid of being wrong.
This has been an incredible deep dive. I'm going to be thinking about rotten milk, the FedEx arrow, and being an outstanding loser for a long time.
As will I. It's powerful stuff.
Thank you for watching. Please like, share, subscribe, follow up in next video.